When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% gain. It's a lot less than 50. Well, that just follow that through. When you go from 4 to 5, that's a 25% gain. But when you go from $9,000 to $10,000 an ounce, that's only an 11% gain. So it's just, again, same $1,000, same $50,000 profit, but 11%, that's almost like a good week the way gold's been going lately. So my point is, people are looking at these $1,000 benchmarks, and that's fine, it's real money. But we made it to 5, we're going to get to 6, but you're going to go 8, 9, 10 really fast for the reason I mentioned, which is it's just easier. And then when you go from 19,000 to 20,000, that's only a 4% gain. 4% gain. That's like a day's trading the way it's going lately. So these benchmarks get easier, and that's why people who watch gold go from 2,000 to 3,000, like, oh man, it'll never get to 20,000. My point is it will, but it could get there a lot faster than people expect. Well, I think gold, and it's funny these days when you talk to people about gold, they want to hear about silver also, and I'm sure we could talk about that. But gold and silver are going to go a lot higher. I feel very comfortable with that. There are multiple drivers, and I'll kind of go through them one by one. The drop, when you get 5,500 in about a heartbeat, it was. I was watching the ticker, we're going to get to 5,000. Of course, I knew we would, but, when it's 5,000, then I think I went to sleep and woke up, it was 5,500. So it was like a 10% drop, literally in 2 days. So, a little pullback's normal. Hedge funds, I always say hedge fund traders don't care about gold, silver, or coffee beans. They just trade. And so if you're a trader and you do a leverage bet on gold and it goes up 10% in 3 days, you probably want to get out of the trade and, mark it up towards your 2026 bonus. So that kind of volatility is normal, but it doesn't really tell us where to peak or anything of the kind. With that said, so what are the drivers? There are several. One is central bank demand. It's we've talked about that before, but it's a big deal. They from 1970 to 2010, central banks were net sellers of gold. Different central banks at different times, believe it or not, in the 1970s, even after Nixon suspended the convertibility of dollars for gold, the U.S. continued to sell gold. We sold about 1,000 tons over the course of the 1970s, got us from 9,000 tons in 1971 to about a little over 8,000 tons in 1980. Then we got the UK to do our dirty work. There are really technical reasons.
Historically, central banks were sellers of gold, especially during the 1970s and 1980s, often at prices that now seem astonishingly low. But over the past 2 decades, a dramatic shift has occurred. Russia, China, India, and others have become net buyers, accumulating thousands of tons. Even smaller nations like Kazakhstan and the Philippines are quietly increasing reserves. Switzerland's controversial sales in 2010 ended after public pushback. Today, central banks serve as a stabilizing force, effectively putting a floor under gold prices. Their strategic accumulation signals confidence in gold as a hedge against geopolitical and economic uncertainty.
Why the U.S. has not sold any gold since 1980. Probably don't have time to go into them. They're legal and has to do with when the Fed took the gold from the banks, but in the 1930s, the Treasury took the gold from the Fed. So they keep stealing it between themselves. But there are reasons to believe that, the U.S. has not sold any gold since 1980. You sell a little bit to the Denver Mint for coinage and get some more, but they maintain that official level the whole time. There are reasons to believe that the U.S. cannot sell. Not only is not a seller, but cannot sell legally. So put that to one side. The UK sold about a third, almost half of their gold in the late 1990s, 1998, 1999. They weren't very savvy traders. They sold at $250 an ounce, not $2,500, but $250 an ounce. Practically gave it away. That was Gordon Brown was the Chancellor of the Exchequer. You should see him around London and the Red Fort at different restaurants. That's known as Brown's bottom. He managed to pick the bottom, a 30-year bottom of the market. He picked it and sold the gold. But even in the 2000s, Switzerland sold 1,000 ounces, and in 1,000 metric tons. Not ounces, 1,000 metric tons. And then there was an uproar in Switzerland. There was a referendum. It failed, but the people in Switzerland were to the point where they wanted a referendum saying that the Swiss National Bank could not sell any more gold. The referendum failed slightly, but the message was sent, and they have stopped selling gold ever since. That brings us to the IMF. The IMF sold 400 tons in 2010. Looks like 200 or so went to India. They never disclosed where the rest went. I'm pretty sure it went to China. But that was it. That was it for large sales by the Western central banks. Since then, central banks have been net buyers. Now, it's not the same central banks. The big buyers have been Russia and China. Russia went from 600 tons in 2009 to about 2,700 tons today. That's, they quadrupled their gold holdings. By the way, just as a quick aside,
Gold's strategic role became starkly visible in Russia's response to Western sanctions. With roughly 25% of its reserves in physical gold, Russia shielded itself from financial attacks. When attempts were made to freeze or seize its dollar assets, rising gold prices offset losses, providing a hidden, yet powerful buffer. Central banks worldwide took notice, prompting increased purchases. Russia's experience illustrates how gold functions not just as a hedge, but as a geopolitical tool, protecting nations from currency manipulation, sanctions, or market volatility. In today's multipolar economy, gold isn't merely an investment. It's a shield in global financial warfare.
That's a big reason why U.S. sanctions on Russia in connection with the Ukraine war have failed, because they can never starve Russia reserves. Because Vera Nabiullina, who's the head of the Central Bank of Russia, I always say she's the only central bank in the world who really knows her job. She put 25% of Russia's reserves in physical bullion. And at the start of the war in Ukraine in 2022, Russia had about $600 billion in reserves, but 150 billion of that was in gold, physical bullion. The U.S. couldn't touch it. The U.S. and Europe conspired to steal about 200 billion of Russian reserves in the form of treasury notes. Russia they had treasury notes, they had gold, they had some other instruments, some euro-denominated notes, but it was mostly treasury notes and gold. And the U.S. and others tried to steal them. They're in a custodian in Brussels called Euroclear, which is one of the biggest custodians in the world. They have $47 trillion of assets in custody. They don't own it, but they're the custodian, registrar for all that. So that was supposed to be like this death blow for Russia. We froze the reserves. Then we were going to steal them, use them as collateral for a loan to Ukraine. So Russia's lawfully acquired assets are being used as a collateral for a loan to pay Ukraine to fight Russia. That's how crazy this whole thing was. It gets worse, but anyway, Russia's going to win the war. They'll eventually get those assets back. But my point is, why was that not a kind of a death blow to Russia's financial position? Well, a number of reasons, but part of it was because they had so much gold. Ironically, because of the effort to steal the Russian assets, central banks around the world, not just Russia, but others, started buying more gold, and it drove the price of gold up. So Russia has, do a quick estimate, has almost tripled the value of their gold reserves in dollar terms.
China has quietly reshaped the gold market. Publicly, the People's Bank of China reports roughly 3,000 metric tons, yet non-transparent holdings in sovereign wealth funds like SAFE may double that figure. This accumulation demonstrates a deliberate strategy, diversifying reserves away from dollar-denominated assets while securing financial sovereignty. Other nations are following suit, mindful of the risks associated with geopolitical tension and U.S. monetary policy. As central banks continue buying while global production hovers around 4,000 tons annually, the imbalance between supply and demand intensifies. Investors see this as a key driver for steadily rising prices and an increasingly resilient market floor.
Because of the run-up in the price of gold, because the U.S. tried to steal the dollar assets of Russia in Euroclear. So what we did on the one hand, by freezing and trying to steal assets, we gave an enormous $100 billion gift to Russia in the form of higher gold prices. So I think I have to do the math, but my estimate is they've made as much on gold mark to market as they lost in these assets stuck in Brussels. So, and I teach this. I teach financial warfare at the U.S. Army War College. So I try to explain this to the students. They're pretty smart. It's a hand-picked class, about 13. They're all kind of future big brains, or future high-ranking big brains, I should say. But and I got a lot of pushback on it. But when you explain it to people, they're like, "Oh yeah, that was kind of a dumb move." What the U.S. did. China, same period, 2009 to today, China's gold reserves have gone from about 600 metric tons to closer to 3,000 metric tons. They very likely have a lot more. They're non-transparent. Well, the People's Bank of China is transparent to a point, but they have another sovereign wealth fund called the State Administration of Foreign Exchange, or SAFE, which holds foreign exchange, including gold, and is completely non-transparent. So we don't know exactly how much gold China has, but there's good reason to believe that this 3,000 tons they report could very well be closer to 6,000 tons or more. So there's China. But you have other buyers: Kazakhstan, Vietnam, Mexico, even the Philippines, India, Japan, which is an ally of the United States, increased their gold reserves. So that does a couple of things. And obviously, it tends to drive the price up, not to stratospheric levels, but to drive it up. But on the other side of that trade, or that equation, is gold output has been constant, around 4,000 metric tons per year worldwide. Now, it hasn't been crashing, and I'm not saying peak gold. You can still find gold, but it's getting more and more difficult. Lower levels, lower grades. I invest in some gold mines, so I'm not a geologist, but I have some familiarity with the kind of the economics of the gold mining industry.
Gold production remains steady but increasingly costly as new discoveries yield lower-grade ores. Meanwhile, central banks and sovereign funds continue to absorb the majority of newly mined gold. This creates a persistent imbalance that naturally supports higher prices. Beyond raw supply-demand dynamics, human psychology amplifies market behavior. Investors anchor to round-number milestones, like $2,000 or $5,000 per ounce, perceiving gains in absolute terms rather than percentages. This cognitive bias often makes market moves appear slower than they truly are. In reality, as prices climb, equivalent dollar gains require smaller relative increases, accelerating price momentum faster than many expect.
But, economics 101, first week, supply and demand. When supply is constant and demand is going up, the price goes up to clear the market. So that's one of the drivers. And it's really attractive for gold investors. Like, by itself, it doesn't mean gold goes to the moon. But what it does mean is you have a kind of informal floor under the price of gold. No guarantees, but if the price goes down a lot, central banks, that's when they come in and nibble, because they're pretty savvy buyers. So you have what I call an asymmetric trade, where you have all the upside, but limited, in my view, limited downside, because the central banks are putting a floor under the gold. So that's a high level dynamic. At the same time, when the U.S. and Europe froze those Russian assets, other sovereign wealth funds and central banks around the world are looking at this. Whether it's Taiwan or Japan or Saudi Arabia, some of these have, if not $1 trillion, close to $1 trillion in reserves. They're saying, hey, what if the U.S. doesn't like something I do? What if they want to treat me the way they treated Russia? Maybe I ought to buy more gold, and they are. I'm not saying they're dumping treasuries. The debasement trade, the narrative from Wall Street is, the world's dumping treasury securities. They're dumping dollars. They're getting out of the dollars. The dollar's over, buy gold, etc. I agree with the buy gold part, but everything else I just said is false. And we have data to back that up. The Treasury has a monthly report. It's called the TIC report, TIC, but basically it's a very simple spreadsheet. And they show all the major countries around the world, and then they show how much gold they have, how many treasury securities they have. I misspoke. How many treasury securities they have, and that's been fairly steady. I'm not saying the world is loading up on treasuries, but they're definitely not dumping them. That part of the narrative is false. And people talk about the dollar being the global reserve currency. Well, currencies are not global reserves. Global reserves are securities. And people don't make the distinction between a currency and a security. Now, the security is denominated in a currency, of course, and that's really what people mean. But it's not like the central banks have pallets of $100 bills in the basement. They don't. They have treasury securities, 2-year notes, 5-year notes, 10-year notes, short-term bills, all the different maturities of treasury securities. And they are not dumping them. If they sell any, and sometimes they do, it's more a sign of dollar strength than dollar weakness. And the reason for that is, why would you sell your treasury securities?
The trajectory for gold suggests that traditional benchmarks will soon feel outdated. Moving from $3,000 to $4,000 per ounce is easier than earlier jumps, while gains from $5,000 to $6,000 may occur almost effortlessly. This accelerating pace is driven by a combination of central bank demand, geopolitical hedging, and investor psychology. The notion that gold could reach $10,000 per ounce faster than imagined is no longer hypothetical. As the world navigates economic uncertainty, trade tensions, and currency risks, precious metals remain a cornerstone of wealth preservation, offering both security and potentially explosive upside in the years to come.
It means you need cash, because treasury securities are not, as I just explained, they're not cash. If you want cash, you got to sell the treasuries, get the cash. What is China doing with the cash? They're propping up their banks and propping up their currency. That's not a sign of dollar weakness. It's the opposite. It's a sign of dollar scarcity and weakness in the yuan or the Japanese yen, as the case may be, and all these other currencies. So even to the extent that some of the countries sell a little bit of treasuries, it's more because they're desperate for dollars, not because they're dumping dollars. So the reality is actually the opposite of the narrative. It's still the Great Reset and the end of the dollar and all this stuff. It's just not true. It is true that the price of gold is going up, but for some of the reasons we just mentioned. Beyond that, there's a simple bit of math that accounts for part of what's going on. And here we can introduce, when I say simple, this is fifth grade math. We don't need calculus for this, but we can introduce behavioral psychology. And in behavioral psychology, we're all humans. We all have cognitive biases, many of which have been identified through pretty good experiments. And one of them is called anchoring. And anchoring means we get an idea in our head, and we kind of anchor on it, and we begin to filter all the evidence through that one idea, through that so-called anchor. And one of them, recently, but very much so now, but in recent years, is we think about the dollar price of gold and how much gold we have and how much money we made, at least on a mark-to-market basis. So let's just take a very simple example. Let's say you have 50 ounces of gold, and gold goes up $1,000 an ounce. Well, you just made $50,000, mark-to-market, okay. And it goes up another $1,000 an ounce. You just made another $50,000, and so on. So people get the $1,000 an ounce times 50 equals $50,000 in profit. They get that in their heads, and it's real money. I'm not saying it's not true. It is true. But that's how they think about the market. But what a lot of people don't realize, at least not right away, is that each one of those $1,000 increments is easier than the one before because it's a smaller percentage gain off a higher base. So when you go from $2,000 to $3,000 an ounce, that's a 50% gain. That's a heavy lift. That took a while. When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% gain. It's a lot less than 50. Well, just follow that through. When you go from 4 to 5, that's a 25% gain. But when you go from $9,000 to $10,000 an ounce, that's only an 11% gain. So it's just, again, same $1,000, same $50,000 profit, but 11%, that's almost like a good week the way gold's been going lately. So my point is, people are looking at these $1,000 benchmarks, and that's fine. It's real money. But we made it to 5. We're going to get to 6. But you're going to go 8, 9, 10 really fast for the reason I mentioned, which is it's just easier. And then when you go from 19,000 to 20,000, that's only a 4% gain. 4% gain. So that's like a day's trading the way it's going lately. So these benchmarks get easier, and that's why people who watch gold go from 2,000 to 3,000, like, oh man, it'll never get to 20,000. My point is it will, but it could get there a lot faster than people expect.